Welcome to Frankurt, everybody. Trevor Hall here, a Mining Stock Daily, reporting from the Deutsche Goldmesse show in cold and gloomy Frankfurt this weekend. Happy to kick things off with the godfather of liquidity, the capital wars himself, Mr. Michael Howell. Mike?
Hi, Trevor. Great to be here.
It's good to do this in person.
Absolutely.
Yeah. Listen, I obviously love your work. Every time you do one of these interviews from a number of different, financial commentators, like I always try to dive in and listen as close as I can, because what you do following liquidity, it's very dynamic and can change pretty quickly. So let's just start off where are we at with the global liquidity right now? What are you seeing from where you sit?
Okay, I think the first thing to say out front is that money moves markets. So what we've got to track is where money is flowing, and we do that by watching central banks very closely. Now, if you look at the central banks worldwide, there are already two that are critically important. One is the Federal Reserve, most obviously, and the other is the People's Bank of China. Most of the others tend to follow their direction. Now, the Federal Reserve has basically been operating a policy, the so-called quantitative tightening policy, pretty much for 18 months or so now. But in actual fact, in reality, if you drill down into what the Federal Reserve is actually doing, they've been doing what we've called a stealth easing pretty much for 12 months now. They more or less flatlined their liquidity inflows, and that was triggered by the British gilt crisis in September of 22. So pretty much 12 months ago. Silicon Valley Bank was another factor urging them to put more cash in. And effectively, the Federal Reserve has been very conscious about the low levels of liquidity in US regional banks. And as a result of that, they've been very, very conservative in their tightening processes. So there's been a much more obvious rhetoric about tightening than in reality has actually shown. The other central bank that's important is the People's Bank of China. The People's Bank of China has been forced over much of the last 2 or 3 years to tighten policy because of the weakness in the Chinese yuan. If you recall, what's happened is that the Japanese yen has collapsed, the Korean won has collapsed. That's put huge pressure on the Chinese currency to keep up, and they've struggled. And they've been tightening policy to try and enact that. Basically, in the last 6 months, they've given up on that policy. They've now injected huge amounts of liquidity into their economy, something like 4 trillion yuan since June. That's $500 billion, and that is basically the basis of what is likely to be a major reflation. So if you look at the global liquidity cycle, which was your question originally, but a long-winded answer, effectively we're seeing an inflection. That inflection began about a year ago, about October of last year. That was the lows of the crisis. What you would expect around that time is you get bank failures. Silicon Valley Bank was, I think, a pretty good example of that. We're still in a sort of a nervous climb out of those lows, but the liquidity cycle is picking up. It's likely to expand much further into 2024. More and more central banks around the world are actually beginning to ease, as well as the PBOC and the Fed. You're seeing a lot of emerging market central banks actually drop interest rates and put liquidity into the system. But generally, the liquidity cycle is rising. It won't be a straight line up, but it'll be rising, and we think the peak is 2025.
Of easing?
Yeah.
Wow, 2025. Okay, so let's put up that future timeline here, because a lot of conversations we've had the last couple of weeks. First quarter of 2024 has kind of been that general area where they think central banks, specifically the Federal Reserve, could potentially be cutting. With this easing on the back of interest rate cutting, how much of that is being driven by an actual recession hitting them in the face?
I don't think recession is the concern or the reality in many ways. The U.S. economy looks to be pretty robust in our view. Yeah. It's seeing what you probably may recall if you go back to the 1990s of rolling recessions in the U.S. economy. A lot of economists were saying recession is coming. It never really took place. What you saw instead was a series of rolling recessions in different sectors of the economy, but the overall economy remained pretty robust. I would suspect that's what you're seeing. You're seeing pretty much a replay of that right now. So the economy is certainly slowing in areas. I mean, cyclical areas are slowing down, but generally the economy seems to be pretty robust. And in many ways, if you take the broader picture of the world economy, there's a lot of evidence that the entire world economy bottomed sometime around about fourth quarter of last year. China was really a major input into that, but the Chinese economy is starting to sort of muscle forward. I mean, look at leading indicators now. Look at evidence from commodity markets. The iron ore price, for example, is now pretty strong. Why would that be if the Chinese economy is definitely in the doldrums, as many people claim? It's not. It's beginning to put its way out. So what you're seeing is an economy generally that is not, one has to say, is not very strong, but it's beginning to climb out of a trough. And in our view, 24 will be a decent year for the world economy. The best environment for, let's say, investment is a period when you've got sluggish growth worldwide and central banks that are trying to, or policymakers that are trying to encourage more growth. And I think that's the picture we've got. Remember, to put this in context, next year is an election year in the US. Will the US authorities want to see or want to risk a recession? What you have is the most political Treasury Secretary I can remember for a long time in Janet Yellen, and her compatriot at the Federal Reserve, Jay Powell, is reasonably political as well. I think they've got their eyes on the ball and they want the economy to be robust next year.
Okay, this is interesting. But Jerome Powell goes up there, and I had a discussion with Grant Williams last week, and he mentioned this line that Jerome Powell stated about navigating by the stars underneath the cloudy sky, which was a dynamic line I've ever heard out of a Federal Reserve chairman. Right. But it's absolutely true. I mean, they are data dependent. They are trying to navigate by the stars, but the outlook is very pessimistic and pretty gloomy. That's where the clouds are. So, if you remain data dependent, don't they have a stance to keep this higher for longer? Can you have higher for longer and an influx of liquidity at the same time?
Oh yes, there's absolutely no question you can. The two things are not that closely connected. In fact, you can have an expanding liquidity environment, and you can have higher rates. But I think the reality is, if you go into next year and you look at the policy stance of the Fed, I think there are going to be two things that will be conditioning it. One is that inflation is likely to come down, I would imagine, quite significantly next year, particularly given the softness in oil prices now. There's a lot of evidence of disinflation already in the system. You're seeing inflation coming down. It could come down seriously by the middle of the year, okay? And that would actually leave real interest rates of 5.25% very high in real terms, probably too high. So I think it would be very hard for the Federal Reserve to justify, particularly going into an election, such high real interest rates, given the fact that they've actually cited real interest rates as a target they want to look at, and they've been suggesting perhaps 2% is the equilibrium level, but 2% is not 3.25% or maybe more. So I think they may have to adjust on that basis. The other thing I think to be realistic is what the Federal Reserve generally wants to make sure is a decent funding background for the US. So the things they're looking at very closely, or more closely than maybe people envision, will be, one is the corporate credit market, which at the moment one has to say is reasonably well behaved. So they've done a good job on that score. And the other is the regional banks. The regional banks are very important in terms of lending to small to medium-sized firms, and it's those firms which generate most of the productivity gains in the US economy. So you don't want to have high interest rates for a long time, and you certainly don't want to have an inverted yield curve, because that really crashes that sector of the market. So effectively, I would say is what they'd like to see next year is a more normally shaped yield curve, and I think that would mean they'll have to get rates at the front end down to some extent.
Yeah, so how about the rates on the long end?
I think the rates on the long end are a very different question.
Yeah.
And they're not really within the gift of the Federal Reserve. They're much more market-driven. They're much more related to other factors. The Federal Reserve clearly plays a role in influencing them, but it certainly doesn't have the total hand on this. And what you've got to start to think about is the backdrop in terms of, number one, supply. There's a huge amount of supply coming forward.
Yes.
And the second thing is prospective demand, particularly from foreigners. Now, what we've seen, it's been very well publicized, is that Chinese and to some extent Japan are actually slowing down their purchases of US treasuries. The second thing is that what you've also got is the supply background is actually getting significantly worse. Now, there are a lot of factors in that equation. One is the fact that we've got aging demographics in the US, so things like Medicare, Social Security are starting to zoom up. On top of that, you've got defense spending. Defense spending is likely to step up dramatically more than from where it is now. If you look at the latest CBO, Congressional Budget Office predictions, they're suggesting in their numbers, and their numbers look bad, one's got to say, a very low level for defense spending. If you push that up to about 5% of GDP, which should be a more normal figure, you're starting to get the deficit blowing out significantly, the debt burden starting to zoom higher, and funding really becoming strained in the US system. Now, this is where I think that I would argue the outlook for gold, precious metals, and generally commodities starts to look a lot better, because ultimately this is creating a monetary inflation. The question to ask is, who is going to fund this huge amount of debt? It's not going to be the foreigners. It's unlikely to be the domestic private sector, because they don't really have the capacity. So it's got to come back to the Federal Reserve. So although everyone is talking about QT and reducing the amount of debt the Federal Reserve holds, in the medium term, they're going to have to step in. Now, the Congressional Budget Office already has them penciled in for a sizable pickup in their debt holdings, okay? So this is not, I'm not going to say it's in the public domain, but people are not talking about it, but the Congressional Budget Office, which is a bipartisan body in the US, basically still envisions the US Fed coming back in. I think they're going to have to come back in a lot more. And that will probably mean that the Fed's balance sheet is likely to grow in double-digit rates, so 10% plus, on average over the 2025-2035 period. So in that period, each year. So you're looking at substantial increases in debt purchases by the Fed monetization. That monetization is monetary inflation. What drives the gold market, and by corollary the commodity markets, is monetary inflation. It is not high street inflation. If you look at the period since, for example, 1994, and 1994 is a very good example, which I'll come back to. But if you look at 1994, from that point to today, the amount of liquidity in the world economy has gone up about 10 times. The gold price, sorry, beg your pardon, has gone up about 5 times. The gold price has gone up about 5 times. Okay, gold mining stocks have gone up about 5 times. Commodity prices, the similar, right. The similar. But we're looking at a parallel. How much has high street inflation or high street prices gone up in that period? The answer is about twice. So what the gold market is actually moving with is the monetary element, the amount of liquidity in the system, not high street prices. There's a great misunderstanding out there that says gold is an inflation hedge. It's not. It's a monetary inflation hedge. There's a very, very key difference. And what we're getting in the next 10 years is monetary inflation, not necessarily high street inflation. High street inflation is a cocktail between monetary inflation and cost pressures. If you start to get cost deflation, which you could have in an aging society, as demographics age, viz. Japan, over the last 20 years, that could cause high street inflation to come down or remain restrained over the medium term. But it's monetary inflation we've got to think about, and it's that hidden element which is really driving movements in the price of gold and precious metals.
Very interesting. I want to ask you, go back and talk about who, if the Fed's going to be the first and last purchaser of U.S. Treasuries here, which is what you kind of laid out here. Do you think gold's starting to sniff this out already? Because it's been a pretty incredible move, but yet there's this line in the sand at $2,000 per ounce where it's having a very, very hard time getting above that and sustaining that move. But do you think gold's kind of starting to sniff out what's going to happen?
I think that's absolutely right. I think you've got a situation whereby gold investors, worldwide, are beginning to realize or maybe investors more generally are starting to realize that gold is a very important monetary hedge. Now, I think you've got to put this in context and say, in the future, if monetization by central banks is the order of the day, which is what we think it is, we think it has to be because there's so much debt around to be monetized. What are your monetary hedges? Okay, generally. Gold is an excellent monetary hedge. We know that through history. You've got more than 2,000 years of experience to show that this works as a monetary hedge. The other is Bitcoin, cryptocurrencies. Now, they're a newfangled way of doing that, but one has to, accept the fact they too are a monetary hedge, unless they're not. But the evidence so far seems to suggest they are. The point is that the sensitivity of gold to increases in liquidity is about 2 to 1. So what I'm saying on that is that if you get a 10% increase in liquidity, you tend to get something like, in fact, the reality is about a 1.5 to 2 times kicker. So that means a 15 to 20% increase in gold prices. Mm-hmm. That's the recent history going back over the last 10 years or so. If you look at cryptocurrencies, it's about 5 times more than that. So they're extremely sensitive as liquidity barometers. So Bitcoin, if liquidity picks up, Bitcoin will go up. I'm not suggesting you want to have Bitcoin necessarily in your portfolio because there's a lot of other things going on, but it may be part of a diversified portfolio against monetary inflation. But gold is clearly a key part in that, and gold equities have got to play their role as well. Yeah. So these are all important monetary hedges.
I mean, there's so many other follow-up questions I have for you. I want to go back to the regional bank issues and what we saw from Silicon Valley Bank and the like. And there was a number of things said and done during that event that caused a lot of people to be actually over-concerned, the thought that every deposit is safe, that the Treasury will guarantee anything above $250,000 in the deposit. If we see more follow-through, let's say this yield curve remains somewhat a mess and somewhat inverted, do we see more follow-through? And really, are those comments that Janet Yellen and team made, I guess, will they be held to test here? And if they are to be held to test, what does the FDIC even mean anymore? It just seems like a worthless acronym.
Well, and then the answer is that when push comes to shove, they'll have to support the system because they always do. And I think that Janet put her cards on the table pretty clearly with SVB when she more or less promised that all deposits would be sacrosanct. Now, there could be a test of that next year if there is another regional banking problem. But as I foreshadowed, if you've got an inverted yield curve persisting for so long, it's almost inevitable you're going to have some banking problems emerging. And I think that's the thing we've got to face. Do they want to run that risk in an election year? I would say no. So that suggests to me they've got to try and get that curve into a normal shape as fast as they can. And that's why I think that if you go into the first quarter of next year, maybe as early as the first quarter, there'll be interest rate cuts mooted, for sure.
I mean, that statement, when I first heard it, I was like, that's the equivalent to Draghi's whatever it takes.
Yeah.
That was the equivalent, but it happened here in the largest economy. And it just kind of shed so much light about how much, the trouble's knocking at the door, but the windfall of trouble could just barrel through that doorway really quickly, given what's happening with the yield curve. It's just absolutely shocking.
I think that's right. I think you only want one more regional bank failure or distress for investors to get really spooked by this, and maybe for the gold market to make a jump upwards, a sizable jump upwards.
Was that in effect when Moody's comes out the other week and does a little wrist slap and threatens to downgrade U.S. debt? What did you take of that?
Well, I think if you look at the backdrop, in many cases the reasoning that they came up with wasn't necessarily valid. But I think at the end of the day, the tenor of what they're saying and the direction of what they're saying has got to make people start to wake up. And the fact is that the US dollar and maybe US treasuries are no longer the sort of pristine collateral or the only safe asset in the world economy now. And they're losing their luster as that vehicle. And what you're starting to see is gold beginning to muscle forward. So if you look at the margin, what are central banks around the world doing? They are not buying US Treasuries, they're buying gold. Okay. And there's actually going to be a slide I'll show in my talk today, which basically looks at gold holdings of the BRIC economies and their friends. So if you look at if you go back to the summer meeting of BRICS Plus, that sort of that grouping of friends of the BRIC economies as well who wanted to join. So if you add all these countries up and you aggregate their gold holdings, as of September of this year, it just surpasses the amount of gold in Fort Knox. So in other words, the amount of gold outside the US now, in let's say unfriendly hands, is bigger than the amount of gold in the US. And that must be a very significant point.
What do you speculate they do with this? Do they generate a gold-backed or at least a gold-involved currency amongst those trading partners?
I think that's a possibility. I think that I wouldn't necessarily say that is inevitable. I think there could be a case for saying that what you've got is a move towards a sort of a stable coin-like structure where gold could be one of those assets that backs that. But I think that the move I would tend to suggest is much more about if you've got foreign exchange reserves and you're building foreign exchange reserves, do you really want every single foreign exchange reserve to go into a US dollar, or would you prefer it to go into something else? Now, what are the alternatives in reality? Swiss franc, okay, decent, but it's just way too small. Euro, well, it's got its own problems, and I think that is more or less a sort of a less attractive version of the US dollar, because you're going to suffer the same pain in that as well, and therefore that kind of leaves gold. So why not accumulate gold? Now the gold market maybe not big enough for all these central banks to start muscling into, but the price almost inevitably has to rise.
Right. I want to ask you about Japan. Your thoughts on Japan here. We thought they might actually allow a little bit more of a natural move, loosen their grip on yield curve control a little bit. I don't think it had the lusters a lot of people were expecting. However, the perspective of doing that is still on the cards. I mean, you mentioned the two biggest banks that you follow, obviously the U.S. and the Chinese central bank. What about Bank of Japan? How are you following them, or are you following them, and what it means for liquidity?
Okay, I mean, the answer is we follow them very closely. They're very important. They're, having said that, much less important than they used to be 20 years ago, but they're still important to watch. I think if you look at Japan, you've got to say two or three things. I mean, one is that number one, yield curve control has sort of been the factor that most people have discussed recently about whether Japan will end yield curve control or whatever. They won't end yield curve control. What you're going to see worldwide is more and more central banks adopting yield curve control. What we're really talking about here is where yield curve control is engaged. So if you said, will the Japanese let the JGB yield move up to 5%? The answer is almost clearly not. They're going to exercise some control. All central banks have to exercise, all central banks and finance ministries will now have to be alert to the levels of their interest rates on bonds, because this is the interest that effectively the government is paying. So you've got to cap it in some way, and you simply can't let these rates go up. So whatever they're going to try, by whatever means, to do that. Just look at the array of instruments that the Federal Reserve is employing now to try and do their quasi yield curve control in the US. Whether it's shifting towards bill finance, whether it's threatening treasury buybacks, whatever it may be. But there's a lot of, if you like, subtle sur la table yield curve control going on. If you look at Japan, therefore, what is Japan doing? Japan is easing the degree of control, so it's moving up from a 1% target to maybe a somewhat unknown. But what they're really saying is they're going to let yields move up a little bit. I think the reality is, as I've said, they're not going to let them move up too far. So in the background, they have not stopped printing money. They have not stopped buying JGBs and monetizing that. The central bank balance sheet of the BOJ, Bank of Japan, has continued to expand against this background. And what Japan is intent on doing is creating inflation. Okay, that's what it wants to do. Wow, has it been successful at that? You start to look at the latest Japanese inflation numbers, and they're scarily bad in my view. Now, if you look at the headline numbers, if you annualize the latest 3 months data, look almost exactly the same as the US, so circa 4% annualized 3-month inflation. But if you drill into the Japanese numbers, what you find is that about 55% of the CPI, the Consumer Price Index basket, is growing at almost 11%, okay? And the rest of it's deflating. In the US, if you do the same dissection, you find pretty comparable figures right across the basket. Most things moving at about 4%. But in the case of Japan, there is huge skew, and it tends to be government-administered prices that are actually keeping the basket down. So the private sector is starting to, push prices through. And this is because of the weakness in the yen in many cases. So Japan has got inflation. Now, the reality is, if you've got inflation and you're a Japanese household, where do you hold your wealth? And the Japanese households have still got substantial wealth. The plain fact is, right now, 50% of that household wealth is held in cash deposits. Okay? That is a brilliant strategy if you've got deflation. It is a crazy strategy if you've got inflation. So those household assets are going to have to shift somewhere else. So where do they go? They're going to have to go into monetary inflation hedges. Now that might mean the stock market. It could do. But it's more likely to mean other types of monetary hedges. So it could be cryptocurrencies, it could be gold, etc. But Japan is the economy where you're starting to see inflation. The West has spent much of the last 3 decades trying to avoid converging with very low Japanese inflation. So if you like, Japanese deflationary pressures have been like a whirlpool sucking the world in. Now what Japan is doing is spending the last 3 years trying to converge with a higher level of Western inflation, and boy is it succeeding. So that's the reality. That's the big problem the world economy's got to face, because Japan will put pressure on interest rates worldwide and savings flows. And I think what you're going to get is a shift towards more monetary inflation hedges in the world, and Japan is leading the way here.
It almost sounds what you expect the Federal Reserve stepping in and being the major buyer of U.S. Treasuries down the road. I mean, that is a complete Japanification.
Correct. It's going to happen. There's absolutely no way out.
That's absolutely fascinating. Let's leave it at that, because I think that's the one thought out of this conversation. We've had a lot of good points in this talk, but I think we need to leave the listeners with that idea, Mike. So I appreciate you coming on.
Great pleasure.
I can't wait to step in and listen to your keynote. It's going to be absolutely fascinating, as your keynotes always are. But I appreciate the time you give us, and enjoy the rest of Frankfurt here in the next couple of days.
Good. Thank you, Joe.
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.